we have just talked about the disposition of PP&E. And sometimes after using a non-lived asset for a while, companies may exchange those assets for other new assets. So the general rule here in this situation is we value the new asset at fair value, and the gain or loss recognized is the difference between the fair value of the old asset and the book value of the old asset. And specifically, when there's an exchange of PP&E, we have three situations. A base case situation, which is the most basic, simple situation. And sometimes the fair value cannot be determined. What do we do in this situation? And when exchange net commercial substance, what do we do? So what is commercial substance? We're going to talk about it in a minute. But first of all, let's look at the base case situation. So an example is company A traded its old equipment plus 430 cash for new equipment. So company A traded, for example, it is dealing with company B, traded an old equipment plus 430 cash for a new equipment. The old equipment has book value of 100, which is cost 500, less accumulative depreciation of 400, and fair value of 150. So in this situation, first of all, we need to calculate the fair value of the new equipment. The fair value of the new equipment, if this is a fair transaction, then the fair value of the asset given by company A should be equal to the fair value of the asset received. So what is the fair value of this new equipment? So the cost of the new equipment is whatever the fair value of the asset given by firm A, which is 150 plus 430. So that is 580. So the general entry here is to company A get a new equipment. And the cost is 580. And company A is also giving up. So it is giving up cash 430. It is also giving out the old equipment, which has the cost of the cost of 500 and accumulative depreciation of 400. So this general entry does not balance. The imbalance is at the credit side. It is gain on exchange. So company A is recognizing a gain here. And if you take a closer look at this 50 is not only to balance this general entry, you can also view it as, because company A, by exchanging its old asset, normally when a PP&E has a appreciation in value, meaning the fair value is more than the book value, we don't do anything. But if it is exchanging it for a new asset, and the fair value here is readily we know what the fair value is. And also, supposing here, we're going to talk about it in a minute, but supposing here that this exchange has commercial substance. So this 50 is actually can be viewed also as, in this situation, we're able to recognize the difference between fair and book value. So which is 50. So this 50, it can also be viewed as the difference between the fair and book value of the old equipment. So this is the first base case example. And then let's look at another example here. Company A trade its old equipment plus 430 cash for a new equipment. The old equipment has a book value of 100 and a fair value of 75. So please take 1 minute, try to write out your journal entry, and you can pause your video for now. So here, the new equipment, what is the cost of the new equipment? If this is a fair transaction, then the cost of the new equipment, which is the should be equal to whatever A is giving up to acquire this new equipment, the fair value of the asset given, which is 75 plus 430. So that is 505. So the journal entry here is we debit equipment new. The cost is 505. We give up cash 430. We're also giving up the old equipment. Which has a cost of 500, and the cumulative depreciation of the old equipment is 400. So this journal entry doesn't balance. The imbalance is at the debit side, and this is loss on exchange. And you can also view this $25. You can also view this as the difference between fair and book value of the old equipment. So this is another way to view it. So those are the base case situation for an exchange of PP&E.